Imagine a world where the price you see on your screen is a lie. Welcome to the terrifying reality of dark pools. While you navigate invisible stock market dangers blindfolded, retail investors' disadvantages are being ruthlessly exploited in the shadows. We are exposing the hidden risks and liquidity issues that drain your account before you even click buy. This isn't just bad luck, it is systematic market manipulation thriving on a total lack of trading transparency. Institutional investors are playing a completely different game, one designed to crush the little guy. They bypass financial regulations to fracture the market structure, leaving you in the dark. In this video, we decode the strategies you need to survive these volatility risks. We will show you how to arm yourself with smarter investment strategies and choose the right trading platforms. It's time to master order execution and reclaim your power. This is your wake-up call for true investment awareness. Let's expose the rigged game.
You know what's truly terrifying about the modern stock market? It's not the volatility. It's not even the risk of losing money. It's the fact that every single time you click buy on your trading app, you're walking into a rigged game, and you don't even know the rules. Have you ever wondered why your orders sometimes fill at worse prices than you expected? Why the stock jumps the second after you buy, almost like someone knew you were coming? That's not paranoia. That's not bad luck. That's the invisible hand of a market you were never meant to see. Right now, as you're watching this, billions of dollars are changing hands in a place that has no ticker, no transparency, and no accountability to you. Approximately 40 to 50% of all stock trades in America happen in this shadow market, and the craziest part? Most retail investors have no idea it even exists. Stay with me until the end, because what I'm about to show you isn't some conspiracy theory. It's documented, it's legal, and it's been happening right under your nose for decades. Imagine going to buy a house, seeing the listing price, making your offer, and signing the paperwork, only to discover that half the neighborhood was bought and sold overnight at completely different prices, and nobody bothered to tell you until after the deal closed. You'd call that fraud in real estate, right? On Wall Street, they call it innovation. The price you see flashing on your screen? That's just the tip of the iceberg. It's the lit market, the public face of trading designed to make you feel like you're part of the game. But beneath that surface is something far more powerful, far more secretive, and far more profitable for those who control it. Have you ever experienced this? Ever felt like the market moved against you the moment you entered a trade? There's a reason for that. And no, it's not because you're unlucky. It's because you're trading in the light while the real players are operating in the dark. What you're about to discover might fundamentally change how you see investing, trading, and the entire financial system. So here's my question. Are you ready to see what's really happening behind the curtain? Before we go any deeper into this rabbit hole, I need you to do something. If what I've said so far has hit home, if you've ever felt that sinking feeling when your trade goes sideways the moment you enter, drop a comment below and tell me your story. Was it a particular stock? A specific day? I read every single comment, and honestly, your experiences help build the case for why this content matters. Here's the thing. Videos like this don't get recommended by the algorithm because they challenge the status quo. The only way this reaches more people like you is if you hit that like button right now and subscribe to the channel. I'm not asking for me. I'm asking because every person who understands how this system really works is one less victim of it. Your engagement is literally what keeps this investigation alive and growing. Now let me take you back to where this all began, because understanding the origin of this shadow market is key to understanding why you keep losing money on trades that should have worked. This wasn't always the way things operated. There was a time when if you wanted to buy a stock, everyone could see your order, everyone had access to the same information, and the price you saw was actually the price being traded. But then something shifted, not overnight but gradually, like a slow-motion transformation that nobody really noticed until it was too late. In 1979, the SEC introduced something called Rule 19c3. On paper, it seemed reasonable enough. It allowed stocks listed on one exchange to be traded on another. The stated goal was flexibility and competition. But what it actually did was crack open a door that would eventually lead to a completely fragmented, opaque marketplace. This rule gave birth to what traders at the time called upstairs trading, literally brokers making deals in private offices, away from the public exchange floor, negotiating massive block trades behind closed doors. It was the beginning of the end for transparency. But the real paradigm shift happened in 2005 with Regulation NMS, the National Market System. The government sold this as a modernization effort, a way to increase competition and drive down trading costs for everyone. Sounds great, right? Lower costs, more options, better technology. Except that's not what happened. What Regulation NMS actually did was shatter the marketplace into dozens of venues, each with its own rules, its own order flow, and its own incentives. Suddenly, the big banks had a revelation. Why should we pay the New York Stock Exchange fees to execute trades when we can just build our own private matching engines and keep everything in-house? Why deal with public scrutiny when we can operate in total darkness? And that's exactly what they did. Today, some of the biggest names in finance, Goldman Sachs with Sigma X, Morgan Stanley with MS Pool, JP Morgan, Credit Suisse, they all run their own private stock exchanges. These aren't small operations. We're talking about platforms that handle billions of dollars in daily volume, executing trades for institutional clients, hedge funds, and high-frequency trading firms, all completely invisible to you and me. The wild part? This was all legal. It was encouraged. It was framed as innovation. But here's the hidden truth nobody talks about. When you fragment a market like this, you don't create competition. You create information asymmetry. You create a two-tiered system where those on the inside have access to liquidity, speed, and data that the rest of us will never see. You create a world where the price you think is real is just a mirage, a reflection of a much deeper pool of trades happening in the shadows. Think about what that means for a second. When you place an order to buy 100 shares of a company, your broker might send that order to a dark pool first, where it gets matched against institutional sellers who are offloading massive positions. You think you're getting a fair price based on what you see on your screen, but in reality, you're being used as exit liquidity for players who have already decided the stock is overpriced. By the time your order hits the public exchange, if it even does, the real action has already happened. The decision to allow this system to evolve wasn't made by some cartoon villain in a boardroom. It was a series of incremental regulatory changes, each one justified by the language of progress and efficiency, each one quietly eroding the foundational principle that markets should be transparent and fair. And now, decades later, we're living in the consequence of those decisions. The average investor has no idea that nearly half of all trades are happening in venues they can't access, with prices they can't see, executed by algorithms they don't understand. This isn't just a technical issue. This is a fundamental betrayal of what a market is supposed to be. If this is making sense to you, if you're starting to see how deep this really goes, drop a comment below and just write, "I see it now." Let me know you're with me on this journey, because we're just getting started. Now I want to go even deeper into why this system exists in the first place. Because once you understand the psychology behind it, you'll never look at a stock trade the same way again. The justification you'll hear from Wall Street is always the same. Dark pools exist to protect large institutional investors from something called market impact. And on the surface, that explanation almost sounds reasonable. Let me paint the picture for you. Imagine you're managing a massive pension fund, and you need to sell 1 million shares of Apple. If you dump that entire order onto the public exchange where everyone can see it, what happens? The market sees a huge block of shares flooding in. Alarm bells start ringing. Other traders assume something's wrong and the price begins to drop instantly. By the time you've sold even half of those shares, the price has crashed so hard that you're taking a massive loss on the back end of your order. This phenomenon is called slippage, and for institutional players moving serious money, it's a legitimate problem. So the solution, they tell us, is to execute these massive trades in dark pools, where there's no public order book, no visible queue of buyers and sellers, no transparency at all. The whale can quietly offload that million-share block without causing ripples on the surface. The trade happens in the shadows, matched anonymously with buyers who also want to stay hidden, and theoretically, everyone wins. market stability is preserved, institutions can execute without panic. It all sounds very sophisticated and necessary, doesn't it? But here's where the trap reveals itself, and this is the part they don't advertise. While these institutions are hiding their massive orders in the dark, claiming they need privacy to avoid market impact, there's another group of players who are often granted access to these same dark pools: high-frequency trading firms. These are the algorithmic predators of the modern market, operating at speeds measured in microseconds, and they have developed techniques specifically designed to exploit the very opacity that dark pools provide. One of the most insidious tactics is called pinging. Here's how it works. HFT algorithms send out tiny test orders into dark pools, like sonar pulses in the ocean, trying to detect the presence of a large hidden order. When they get a response, a partial fill or a specific type of rejection, they know there's a whale in the water. And the moment they identify that whale, they race back to the public exchanges and start betting against it. They front-run the institution's position. They scalp the spread. They extract value from the very information asymmetry that the dark pool was supposed to protect. So the institution that went into the dark pool to avoid market impact ends up getting picked apart anyway, just by a different predator using a different method. And you know who really loses in this scenario? You, the retail trader who's operating on the lit exchanges, completely unaware that half the market's liquidity is locked away in private venues, completely blind to the fact that the price you're seeing is being manipulated by invisible forces on both sides. When that pension fund finally finishes unloading its position in the dark and the stock price adjusts on the public market, you're the one left holding the bag. You bought at what you thought was a fair price based on visible supply and demand, but in reality, you were just the exit door for institutional money that had already decided the party was over. This is the hidden tax on retail investors that nobody talks about. Every time you trade, you're operating with incomplete information in a fragmented market designed to benefit those with access, speed, and scale. The transformation that happened between the old transparent exchange model and today's dark pool ecosystem wasn't just technological, it was philosophical. We moved from a system where fairness was enforced through visibility to a system where efficiency is prioritized over equality, and the impact of that shift is staggering. The decisions that regulators made decades ago, the ones that seemed harmless at the time, have created a marketplace where the average person is structurally disadvantaged before they even place their first order. And the most frustrating part? This isn't some hidden conspiracy. It's all documented. It's all legal. The SEC publishes reports on dark pool volume. Financial news outlets occasionally mention it in passing, but the revelation never breaks through into mainstream awareness because the system benefits from your ignorance. The more you don't know, the easier it is to extract value from your trades. If you're starting to feel that shift in perspective, if this is changing how you see the market, drop a comment and write, "The game is rigged." Now let's talk about the actual cost of this system, because this isn't just some abstract Wall Street inside baseball. This directly affects your money, your returns, and your ability to build wealth through investing. The core principle that's being violated here is something called price discovery, and understanding what that means is absolutely critical to grasping why dark pools represent such a fundamental threat to market integrity. In a fair and transparent market, the price of a stock is supposed to reflect the true balance of supply and demand at any given moment. When more people want to buy than sell, the price goes up. When more people want to sell than buy, the price goes down. Simple, right? That visible interaction between buyers and sellers, that constant negotiation happening in real time on a public exchange, is what creates an accurate price signal. That's price discovery. It's the entire foundation of how markets are supposed to work. But here's the problem. When 40 to 50% of all trading volume is happening in dark pools, completely invisible to the public market, that price discovery mechanism breaks down. The price you see on your screen is no longer a true reflection of supply and demand. It's a partial reflection, a distorted signal based on incomplete information. It's like trying to navigate using a map where half the roads are missing. You're making decisions based on data that's fundamentally flawed, and you don't even know it. Let me give you a concrete example of how this plays out in real time. Let's say you're watching a stock that's been trading at $50 all morning. The volume looks normal, the chart looks stable, and you decide to buy 100 shares because your analysis tells you it's undervalued. What you don't see is that in multiple dark pools simultaneously, institutional investors have been quietly unloading tens of thousands of shares at $50 and above for the past 2 hours. That selling pressure never showed up on the public order book. It never moved the visible price. You had no way of knowing it was happening. Then, sometime later, could be minutes, could be hours, those dark pool trades finally print to the consolidated tape, meaning they get reported to the public record. Suddenly, the market realizes there was way more supply than anyone thought, and the price adjusts downward to $48. You just lost $2 per share, not because your analysis was wrong, but because you were operating with phantom liquidity, making decisions in an information vacuum while the smart money was already executing their exit strategy in the shadows. This is what I mean when I say the market has become a two-tiered system. There's the market you have access to, where your orders are visible, your intentions are telegraphed, and your execution is subject to slippage and price impact. And then there's the market they have access to, where orders are hidden, execution is anonymous, and information flows in one direction, away from you. The transformation of the marketplace into this fragmented, opaque structure wasn't sold to us as a way to disadvantage retail investors, but that's exactly what it accomplished. The decisions made by regulators and exchanges to allow this ecosystem to flourish were framed as progress, as innovation, as necessary evolution for a modern financial system. But the impact has been to create systemic inequality baked into the architecture of how stocks are bought and sold. And here's the truly insidious part. This isn't a glitch. This isn't an unintended consequence. The revelation that should shake you is that this outcome was predictable, and in many ways, it was the point. When you remove transparency from a market, you create opportunities for those with access to privileged information and private venues to extract value from those without. Every time you trade, there's an invisible tax being paid, a spread being captured, a tiny edge being exploited by someone who can see the full picture while you're stuck looking at shadows on the wall. The mentality shift that needs to happen here is profound. You've been taught to think of the stock market as a level playing field where anyone with a brokerage account can participate and compete. But that's the illusion. The real game is happening behind the curtain, in venues you can't access, using data you can't see, at speeds you can't match. Your journey as an investor has been taking place in a rigged arena, and most people go their entire lives without ever realizing it. The worst part is that this system feeds on itself. The more volume that moves into dark pools, the less reliable public prices become. The less reliable public prices become, the more advantageous it is for institutions to trade in the dark. And round it goes, with retail investors left further and further behind, making decisions based on mirages while the real market operates in a parallel dimension. If this is resonating with you, if you're realizing that every trade you've ever made was happening in a system designed to keep you in the dark, drop a comment and just write, "I'm waking up." Now I want to show you exactly who profits from this system, because once you follow the money, the entire picture becomes crystal clear. The primary beneficiaries of dark pools aren't the institutional investors they claim to protect. It's the broker-dealers themselves, the massive banks that operate these private exchanges. And the way they extract value is both brilliant and deeply corrupt. When a bank like Goldman Sachs or Morgan Stanley routes a trade through their own dark pool instead of sending it to a public exchange, they accomplish several things simultaneously. First, they avoid paying exchange fees, which might seem small on a per-trade basis but add up to enormous savings when you're processing billions of dollars in daily volume. Second, they capture the bid-ask spread for themselves. In a traditional exchange, that spread, the difference between what buyers are willing to pay and what sellers are willing to accept, gets competed away by market makers. But in a dark pool, the bank controlling the venue can internalize that spread as profit. They're essentially acting as both the casino and the house, taking a cut from every transaction that flows through their system. But the real money, the transformation in how these institutions generate revenue, comes from something far more insidious: selling access. Remember how I told you that high-frequency trading firms use tactics like pinging to detect large hidden orders in dark pools? That's only possible because the banks running these pools allow them in. And they don't allow them in out of the goodness of their hearts. They allow them in because HFT firms pay for that access through various fee structures and arrangements. The banks generate massive volume by letting predatory algorithms into the pool, and that volume translates directly into revenue. Now here's where it gets truly disgusting. And this isn't speculation or conspiracy theory. This is documented fact that resulted in major legal penalties. In 2016, Barclays and Credit Suisse were hit with fines totaling over $154 million. The reason? They had been marketing their dark pools to institutional clients with explicit promises that these venues were safe havens, protected environments free from predatory high-frequency traders. They told pension funds, mutual funds, and other large investors, "Trust us, your orders are secure here. We've built walls to keep the wolves out." But behind the scenes, those same banks were secretly granting access to the exact high-frequency trading firms they claimed to be blocking, specifically to increase trading volume and boost their own fee revenue. They sold their clients out. They lied about the safety of their pools, allowed predatory traders to feast on the institutional orders they were supposed to be protecting, and pocketed the profits from both sides of the betrayal. And the penalties they paid? $154 million sounds like a lot until you realize these banks generate billions in annual revenue from their dark pool operations. The fines were a cost of doing business, a slap on the wrist that barely registered on their balance sheets. The mentality that drives this behavior is pure extraction. These institutions don't see themselves as service providers or intermediaries facilitating fair markets. They see themselves as profit-maximizing entities operating in a regulatory environment that allows them to get away with almost anything as long as they pay the occasional fine. The decisions they make aren't guided by ethics or fairness. They're guided by what generates the most revenue with the least risk of meaningful consequences. And here's the hidden truth that should fundamentally change how you view the financial system. This wasn't a one-time scandal. Barclays and Credit Suisse got caught, but the business model remains intact. The incentive structure that led them to deceive their clients is still in place. Other banks watched what happened, paid attention to how small the penalties were relative to the profits, and made their own calculations about acceptable risk. The revelation isn't that some bad actors broke the rules, it's that the rules themselves are designed to enable this kind of exploitation. Dark pools exist in a regulatory gray zone where transparency requirements are minimal, oversight is limited, and conflicts of interest are baked into the structure. The banks that operate these venues are simultaneously the referee, the casino operator, and a player at the table, and nobody in power seems to think that's a problem worth fixing. The impact on you as a retail investor is both direct and profound. Every time your broker routes your order through payment for order flow arrangements to a market maker, every time that market maker decides whether to execute your trade internally or send it to an exchange, every time a dark pool prints a block trade that moves the price after you've already committed your capital, you're on the losing end of a system designed to extract tiny amounts of value from millions of transactions. And those tiny amounts add up to billions in profits for the institutions running the game. If you're starting to see the full scope of how deep this corruption runs, drop a comment below and write, "They sold us out." What I'm about to share with you now is crucial, because knowledge without action is just entertainment, and I don't want you to walk away from this video feeling helpless. You can't single-handedly dismantle the dark pool infrastructure that Wall Street has spent decades building, but you absolutely can stop being easy prey for it. The transformation from victim to informed participant starts with changing your approach to how you execute trades, and there are specific tactical decisions you can make right now that will immediately improve your position in this rigged game. First and most important, stop using market orders. I know they're convenient, I know they feel fast and simple, but every time you click that market buy button, you're essentially telling the system, "Give me whatever price you want, I'll take it." That order gets routed through your broker's order flow arrangements, potentially internalized by a market maker or sent to a dark pool, and you have zero control over the execution quality. You're volunteering to be the exit liquidity, the person holding the bag when everyone else has already moved. The alternative is limit orders. When you place a limit order, you're setting a maximum price you're willing to pay or a minimum price you're willing to accept, and you're forcing the market to meet your terms. Yes, it means you might not get filled immediately, And yes, it requires slightly more patience, but that patience is the price of not getting taken advantage of. You're drawing a line in the sand and saying, I will only participate at this price or better, which completely changes the power dynamic. Instead of begging for execution at any cost, you're demanding fair value. Second strategy, start watching the tape. Now I know this sounds technical, but stay with me because this is actually simpler than it sounds. Most trading platforms offer something called time and sales data, which shows you every single trade that executes in real time, including the size and price. Tools like Bookmap take this further by visualizing order flow and liquidity in ways that reveal hidden activity. What you're looking for are block trades, massive prints, sometimes hundreds of thousands of shares, that appear on the tape but didn't create any visible movement on the price chart. When you see a huge trade execute without moving the market, that's almost certainly a dark pool transaction finally printing to the consolidated tape. It's a clue that institutional money just moved, and it gives you insight into what's happening behind the curtain. You won't catch everything, but you'll start to see patterns that the average investor completely misses. Third, and this is more about the long game, support transparency. There are regulatory changes coming down the pipeline, like amendments to SEC Rule 605, which are designed to force brokers and market makers to disclose more detailed information about execution quality. These rules are being implemented specifically because retail investors have been getting screwed for years, and awareness is finally reaching critical mass. The more people understand how the system works, the harder it becomes for these institutions to operate in the shadows without consequence. Awareness is genuinely our best weapon here, because public pressure is what drives regulatory action, and regulatory action is what constrains the worst abuses. Now I want to be clear about something. These strategies won't make you immune, and they won't level the playing field entirely. You're still operating in a market where institutional players have advantages in speed, access, information, and capital that you'll never match. But what these tactics do is shift you from being completely blind and defenseless to being informed and strategic. You're making decisions with your eyes open, you're protecting yourself from the most blatant forms of exploitation, and you're refusing to play by rules designed to keep you losing. The mentality shift here is everything. For too long, retail investors have approached the market with this sort of naive optimism, believing that if they just work hard enough, analyze well enough, pick the right stocks, they'll succeed. And that's partially true, but it ignores the structural reality that the game itself is tilted. The revelation that needs to sink in is that success in this environment requires not just good analysis, but also defensive awareness. You need to understand the battlefield, recognize the traps, and move accordingly. The impact of adopting these strategies compounds over time. Every trade where you use a limit order instead of a market order, every instance where you spot a dark pool print and adjust your thesis accordingly, every moment where you choose informed caution over blind participation, these add up. They represent tiny reclamations of power in a system designed to take it from you. Your journey as an investor doesn't have to be one of constant victimization. You can operate with intelligence, with awareness, with tactical precision. The bastidors of Wall Street will always exist, but you don't have to stumble through them blindfolded. If these strategies make sense to you, if you're ready to start trading with your eyes open, comment below. I'm taking control. If you've made it this far, you're no longer part of the crowd that trades blind. You understand something that most retail investors will never grasp. The market you see isn't the market that matters, and that knowledge, that shift in perspective, is what separates those who get taken from those who navigate intelligently. If this video changed how you see the stock market, if it pulled back a curtain you didn't even know existed, do me a favor and hit that subscribe button right now. This channel exists to expose the mechanics behind the machine, and the only way we grow is if people like you decide this kind of content is worth supporting. Drop a comment below and write, "I see the iceberg," so I know you made it to the end. I read these comments, and honestly, it's what keeps me digging deeper into these topics. And if this video delivered value, if it armed you with information you can actually use, leave a like. It helps more people find this content. And every person who understands how dark pools work is one less victim in the system. Now here's the thing. Knowing where they hide is only half the battle. You also need to understand how they steal. There's a video right here that breaks down high-frequency trading and shows you exactly how algorithms front-run your orders in milliseconds, extracting value before you even know what happened. It's the next piece of the puzzle, and if you're serious about protecting yourself, you need to watch it. Click it now and keep going. The game is still being played. The question is whether you're going to keep playing blind or start playing smart.